Does this look like 2000 or is this just really different?
It's actually worse. We are going to have a huge, huge problem meeting the needs of the expectations that the market has built in these AI stocks. And the moment when people realize it's not happening or certainly close, that's when it will cave. It didn't take something like that to be labeled crazy. I can tell you that gold has always been treated like kryptonite, David, by Main Street, Wall Street. And here's the big news.
It's my great pleasure to welcome back Peter Grandich, founder of Grandich and Co. We're going to talk about his outlook on gold, silver, mining stocks, and the economy. It's a timely update, Peter. You've been on many times on the show. Last time, I believe, was the summertime, and it was a very different environment back then for the precious metals and for the economy. So it's a very good time to get your update right now before the end of the year. Welcome back to the show, Peter. Good to see you.
Always a pleasure to be with you, David.
I brought up the fact that you're on the show in July. Since then, the GDX has continued to run up. Gold mining stocks, many of them hit an all-time high. Gold hit an all-time high. Silver reached $50 an ounce for the first time since 2011, which we'll talk about. Are you taking any profits on gold mining stocks now?
Well, since we last spoke, I did because I felt there'd be a correction. But as I stated earlier today to my own clientele and readers, it's been an impressive short-lived correction. The physical demand for both gold and silver, impressive, just continues to even surprise some of the most ardent bulls like myself. So I would say that obviously since we last spoke, I enjoyed the ride up, got near the highs, got out, but went back in recent days because the strength is just, the biggest change, I've been acting on 42 years, the biggest change, Dave, that is changed is the demand in physical market overpowering the paper market. What has always hindered the gold market in past bull markets is the inevitable paper market coming to town and basically playing the bearish side. They've been basically annihilated. They may come back for an old timers game because once a year the baseball teams have an old timers game, but basically they're done. And the reason they're done is basically the gold market has moved to the Far East and particularly out of China and all. And the physical market now dominates the paper market. And so that has been a major, major plus. And then, of course, the question I think one should ask is there anything that can end the bull market, not just a correction? The only thing I see on that can possibly do that is central bankers go from major buyers to net sellers. And there's not even a hint of that. So all systems are go other than periodical corrections or consolidations. I still think silver lags a little in that, it'll at times run a little bit ahead of gold, but gold is still charging ahead. And I didn't think I'd live long enough to say this, but I really believe that 5,000 now is only a question of when, not if.
A few years ago, anyone who suggested $5,000 was labeled crazy. That was only a few years ago. Now it's 20% higher.
Yeah, well, it didn't take something like that to be labeled crazy. I can tell you that gold has always been treated like kryptonite, David, by Main Street, Wall Street. And here's the big news. It didn't get a lot of coverage, but I really think your listeners should grab hold of this. We've seen major financial institutions, household names, now recommend as much as 20% in gold as an allocation, which any time before a couple of years ago, if anybody would have said that, they said it'd have to be a misprint. How could XYZ say I should own as much gold as own bonds? But we've seen a couple of major brokerage houses talk the 60-40 into a 60-20-20. And that's because they're recognizing that there is something afoot here. The gold market is moving, not because of a trade, not because people think they can make money buying and selling it, but it's moving towards a backing of some sort, regionally or otherwise, in a monetary reason as the US dollar continues to lose its economic and military power. And I just think as long as those cards are all together, the least resistance for gold is up.
Let's talk about a narrative that I commonly heard back in 2020 when I first started in this business, Peter, that if gold moves towards $5,000, it means something seriously is wrong with the world. Either we have some sort of global war on the verge of some nuclear catastrophe, or the global financial system is on the verge of a meltdown. Nothing of that sort is happening to that degree right now, Peter. So why did gold move up to $4,000 when none of those doomsday predictions that some other people have given me 5 years ago really came to pass? Gold didn't need that.
David, there's a handful of doomsday predictions that you make with people that peddled gold. They would have said that they're the same, the opposite people on Wall Street. You can throw off the Empire State Building all the way down. They'll tell you the same thing. Hey, so far so good until it
Yeah.
hit the ground. So I don't look at that. I'll just say this: the parabolic move of it has been supported in the physical market. And that's the important part. Even to this date, people are lining up in the Far East on weekends from hard-earned money and buying physical gold. While here in the US, those who are going to the mall to buy things they don't need with money they don't have. So there's a major world shift going on monetarily, economically. Trump has been called by China. He folded. All the talk that we had, if you go back and watch all the comments in January, February, March, April, what was supposed to happen with the trade wars and all the things that were going to happen, nothing really has happened. The BRICS are moving forward. Countries are moving more away from the United States on average than closer, and there will be some sort of change, which will start with the BRIC countries themselves beginning to use some sort of currency exchange that will include gold.
Why gold in particular? Why can't they use another currency like the yuan or the euro or even silver?
Because it's currency. And you know, call me old fashioned. I still rather have something that can drop on my foot and hurt me than something that's claimed somewhere's in a computer sitting on a ledger somewheres. And I just think central banks who still control, whether you like it or not, the Bitcoin people don't like to hear this, but whether you like it or not, the central banks are the biggest players in the money game, and they are not touching that. They are focused on gold and only gold. And until that changes, gold can only continue to work higher over time.
Well, let's talk about the chart now. We've got here. Let me take a look at my. Let me show you my screen now, Peter. This is the price of gold now. As you can see, 2011 was the then all-time high, and then it retraced the 2011 high back in 2020. It stabilized around there. You can tell. You can see from this chart here that the gold price stayed high for it peaked around September 2011, and then it stayed high for another 1 year. Peter, November 2012 was when gold started to destabilize. So if history were to repeat itself, it looks like we've got another year before we repeat 2011. But that's assuming we do repeat the same pattern. Maybe we'll consolidate and go a little higher. People are trying to find reasons for either case. What do you see, Peter?
Well, people are trying to find reasons for gold not to continue higher. So let me discuss that with you, if I may, Dave.
Yeah.
So when I entered the brokerage business, when most people that are investment advisors now weren't even born, the Dow had gone only up between 700 and 1,000 for 13 years. In fact, in the early 1980s, a famous Business Week cover page said equities are dead. Basically, everybody on Wall Street felt that because of all sorts of problems back then, there was just no way that equities can go much higher. And then a young man came out of Gainesville, Georgia, that no one heard of, with a process no one heard of called the Elliott Wave Theory, named Robert Prechter Jr., and predicted 3,600 on the Dow. And he was ridiculed. Within a few years, he proved pretty well correct and then some. And of course, it went much higher. Now, I'm not saying that gold's going to 47,000 too over the next 30 or 40 years. What I'm just saying is there's nothing out there to say that gold can't go higher. The problem is that it's still not widely accepted in the general financial community in North America. Now, that's different when you go to Asia. But here in North America, we're still seeing most people caught in the world of financial assets and stocks and bonds. So then the question I ask is, well, if gold could do that with all that going against it, and now we're seeing cracks where they're starting to come over to it, where could it go? If you want to take history, the typical history has been we've seen gold become as much as 4 or 5% of the typical portfolio. It's still believed less than 2% at this point in time. So if you want to use history, you can also say the history says it could still double. Now, I'm not saying it's doubling, but what I'm just saying is I think it's a mistake to think it has to go back down simply because it always did something before. Remember, gold was a paper trading vehicle when you looked at that 2010 and 11. Now it's a physical market. See, the Bitcoin argument will go, hey, listen, there's only so many. If more people keep buying it, it should go up. Now that's questionable why it isn't going up despite all that. But the same can hold true for the gold market. If more people are going to be buying it than before, then the pressure is going to be to the upside, not to the downside.
Gold prices have continuously hit all-time highs this year in 2025. Stellar Gold in the mining industry is a name worth watching. Today's sponsor, Stellar Gold, is a gold developer with two of the largest undeveloped gold projects in Canada, the Tower Gold Project in the well-known Timmins mining camp and the Carlomac Gold Project in the Northwest Territories. They just released plans for the towers and the numbers are impressive. The project could deliver a $2.5 billion after-tax net present value at spot gold price and produce 273,000 ounces annually over 19 years. Backed by a proven management team with a relentless drive for success, Stellar is positioned to unlock serious value for investors. To learn more, go to stellargold.com/David Lin in the link down below or scan the QR code here. And don't forget to read their cautionary statements, forward-looking information, and risk disclosures, which are all available on their website and on SEDAR. Last time you were on the show, I think you mentioned that there may be another melt up before the final reversal. We had that melt up. Gold was a lot lower in July than it is now. So now we're back up to above $4,000. In fact, today it's $4,100. Is this the melt up that happened already, or is there more, you think?
Well, a melt up in terms of the stock market, which felt it could run towards the end of the year.
Oh,
But
yes.
going into 2026, I think it's going to be a totally different story. But again, this parabolic move, and you were right, that's a basic straight line, and there's concern. But look at the corrective nature that we just saw in the last couple of weeks. We had one big washout day. It was $250 down. We tested a couple of times a little bit under 4,000, and physical buying turned the market, not futures trading. And that is the signal of how much people want to buy if there's any weakness in gold at all. That's why I can't make an argument for it much lower, because there's too many underlying strength demand right now for it.
Okay, well, are you still all in gold? I think at a certain point, a couple of years ago, you told me you were all in gold. Now, when you're looking around at all the other marketplaces, commodities, stocks, and things in the S&P 500, everything's gone up. So there's a lot of opportunities right now in the market. People argue, are you all in gold right now?
So in 2021, I sold all my stocks and bonds but one to own physical gold on the belief it would outperform stocks and bonds. And it did through this year. However, I took profits earlier. I went into major mining stocks, uranium, and then I backed up the truck to junior resource stocks. And then I shrunk my ownership of junior resource stocks to a handful of them based on takeovers. The rest of my money is in money markets, CDs, and T-bills. I am very concerned past this year that the next couple of years could be very damaging to the financial markets in general and actually see losses. And at my age, and for a lot of people that I advise that are at my age, the risk is too great now to have large exposures to the financial markets. So while I'm still very bullish on metals, I think we're seeing a marked increase in mergers and acquisitions in the metals and mining industry. That's only going to increase into next year. I am quite cautious overall for myself or anybody that's in, particularly like myself, that really couldn't afford loss of principal.
Diversification, then. How do you view that subject?
Well, again, it all depends on an individual. I think a man of 70 with $3 million needs to be far more conservative than a man at 30 with $100,000, because there's a lot of years left for that person to work and make up if things are poor. Unfortunately, here in the States, I can't speak for Canada, but I suspect it's similar. We have 70% of our current people living paycheck to paycheck. We just saw it with this economic shutdown, how within just days there were people that literally couldn't get food on their own table. A very small percentage is prospering from the growth in the stock market. But overall, economically wise, more Americans are going sideways to down than up. Eventually, that spread becomes too much. And quite frankly, that's one of the reasons why the socialism talk that's out there, some people call it communism, social, whatever they want to call it these days, is getting an ear, because of a lot of those people that are down at that lower thron don't feel there's any chance. And these people way up at the top here are living, like kings, so to speak. And that, I think, is going to become a major economic problem. We have a retirement crisis. We have an infrastructure crisis. We, we have a political division in the United States that I think is as bad as it was before the Civil War that we had a couple hundred years ago. And we saw that during this shutdown, how parties want nothing to do and do anything that they can not to help each other while Americans suffered. And I think that's going to fall more and more into ways of the world in the United States in 2026. Trump loses more of his political clout that he started his administration with. And then there's this political division now that we're seeing. And you only have to look at our biggest city right now to know how different things are changing in the US than just a few years ago.
Well, let's talk about that. A new mayor was just elected in your biggest city, New York, Mamdani, and you don't live too far from New York. I know you're in New Jersey, but we can talk about New York. Some of his highlight economic policies: he wants to raise the income tax surcharge on top earners by 2%. On New York City residents earning more than $1 million a year, increase corporate tax rates from 7.25% upwards to I think 11.5%. I think I have to double check that. Build 200,000 new affordable housing units over the next 10 years. He wants to provide universal health, universal childcare, free buses, free grocery stores that are run by the city. So it's very. We've seen these policies play out in other parts of America and the world. It's just tax the rich, give to the poor in the form of free things, utilities, buses, groceries, childcare. That's some of the things that I've listed. Oh, also increase the minimum wage to $30 in the city. Is that going to help? Let's just forget the rich for a minute. Is that going to help the people at the lower income bracket like you were talking about?
Well, first of all, it's not widespread in the US at this moment. This is really something that's
Yeah.
fairly unique at this point. We're seeing it now. We have an idea of what it can lead to because we can look overseas to Europe, places like London, Paris, Dublin, where that has happened, and then what has caused the issues that have happened there. All those things you mentioned, they all have one thing they all need. They need money. Government can only get money from taxing others. I will tell you already there's been a great strain of wealth exit out of New York City long before this gentleman was even considered possibly becoming mayor. That was already happening. It's only greatly accelerating now. And the problem that he'll arrive with is there won't be anywhere amount of people that he can take from in order to give those services, whether they're justifiably or not. Unlike the United States, which has a printing press, the New York City doesn't have that. And it's also somewhat impacted by what the governor of the state will support and all. And I can tell you this, as long as Trump is president, he will get no help at all from the federal level. So those were all good things, and I'm sure it helped him get elected. But I think achieving it versus saying it is going to be two different things.
Would you want to see free buses and free grocery stores in your neighborhood, and maybe taxes raised on some wealthier property taxes raised on some wealthier neighborhoods, which is what he's proposing, but then reduced in some other neighborhoods that are not as affluent?
You know, over the centuries, there have been movements towards socialist and communist-like states, countries.
Hmm.
And as poor as people can make, and there's a lot of things wrong with capitalism, capitalism is still at least the least of all evils, if you want to call it that. Uh, I think the problem arises is that people are gotten too accustomed to expecting things now that a generation or ago was considered a luxury in any way, shape, or form. And the problem now is that we have this K economy. And again, I can't speak for Canada, but here in the US, we know that the top 10% wealthiest people in America own 86% of all the assets. And the next 40% own the next last 14%. And then half the population owns no assets, David. In fact, 50% of all workers, or 20 of that bottom 50, or 25% of all workers right now, are using some sort of debit mechanism just to pay for necessities. That can't last very long. Even if you get enough credit from a credit card, even if you make the minimum payments, eventually even the minimum payments can't be met and all. So we're at a crisis level there already. And one of the big concerns that I think is not being spoken about in all circles, in mainstream financial media, and hopefully much better media services like your own, is how the government now wants at this point in time to open up private equity to the general investment public when we're now learning that the private equity companies, both on equity and in credit, are in dire problems. BlackRock's just had two huge investments of their own in the private credit sector go from being priced at 100 a couple months ago to zero now, bankruptcy. And now we want to let the public in so they can get a hold of these things. This is all signaling of much, much dire situations underneath. Another reason why I believe gold, particularly ownership of gold outside the United States, is looking at what's happening here in the United States and going, whoa, wait a minute, they got a huge problem.
For somebody who's planning for retirement, and I know you work with a lot of retirees, Peter, they're probably looking at the markets, and if they're invested in any of the major asset classes that we discussed so far, stocks, anything in the S&P, well, if they had bought an S&P 500 index, gold stocks, gold itself, silver itself, even Bitcoin, all these assets went up on the year. Well, actually, Bitcoin was more or less flat on the year, but that's a different story. The point is, everyone is up in their portfolios who's invested prior to 2025, and they're thinking, should I take some profits now and have more cash for my retirement, or should I ride out this asset wave? How do you make that decision, Peter?
Well, it's a tough decision. Most people didn't want to do what I did in 2021. 98% of our clients didn't. I'm certain a lot of my clients now are not going to take the approach that I believe we have to start with in January, where cash and cash equivalents have to be the single largest part of our investment. I really believe over the next couple of years, Dave, it's not how much you're going to make, it's how much you don't lose, which is going to separate the winners from the losers. So my focus is going to be on capital preservation, not appreciation. You're right. We've had some great years. I shared in it. This is the best 5 years and best single year I had. But to think that's going to happen next year, I think is going to be a mistake. And that's why I want to err on the side of caution.
But if you're more heavily in cash then, Peter, are you assuming that inflation isn't going to be a problem because that's going to eat away the value of the cash?
Well, if it eats away at it, and if I earn 4 and inflation 6 and a 2% loss versus a 20, 30, or 40% loss in stocks, I'll deal with that. And like I said, I think there's a lot of other things that are occurring, including the fact that we don't know how we're going to get to this 50 trillion in debt. You know, we just had the fastest period of time where our debt increased by $1 trillion. I have to tell you this, David, we're at 38 trillion. When I started in the business, honestly, on the life of my child, I didn't know what a trillion was. I didn't know how to compute it. Nothing was considered a trillion. Now we have 38 trillion heading for 50 trillion. Dave, at 50 trillion, at 5% interest, we're going to have a 2.5 trillion interest payment. We've never even made more than less than 6 trillion as a country. And now, by the way, Trump, shockingly, seriously, I mean this, is now following a Biden precedent and wants to forgive certain student loans. That's all good. Here's the problem with that. Student loans are the single largest asset that the United States has right now, 27%. So that income that we're going to lose by forgiving those loans has to be made up somewhere. What are they going to do? They're going to tax us more in order to make up for it. And here's the other problem with that, David, and you'll be talking about it someday if they go that way. Where do you stop? What happens when people start having serious problems with mortgages, car loans, consumer loans, all these other things? We're heading here in the United States in a wrong direction. I know that upsets, and I'll get the emails from the MAGA people, and he's going to make America great and all that again and all. There's too many underlying issues. Not his fault. Many have come from past administrations that are still getting worse, not better. So that's why I am taking such a cautious, especially after this blessing this year of having these type of results, that I really think for the next couple of years going forward, people should be much more cautious, especially if they have gray hair or no hair.
Well, let me just play devil's advocate here. The bulk of the tariffs that he wanted to implement were already done this year. And in fact, the Supreme Court's already challenging the legality of some of these tariffs that he implemented. Now, if the markets wanted to revolt against these tariffs, they would have done so already. But like you said, this is the best year for a lot of markets ever. So clearly these tariffs aren't having that dramatic of an effect on inflation, on job losses, on capital gains, on growth of the economy overall, as some critics of Trump's plans would say. That is the argument. How would you respond to that?
David, the United States market is ranked 65th right now in performance for this year. Yes, you're right. In some points, and depending if you go to the narrowest part of it, there were decent gains, but it hasn't been fantastic. On the
Mm-hmm.
bond market, people have been basically flat. The long bond is back, heading back above 10% on the 10-year Treasury, back well above 4%, despite a Fed cut. So the issue that I think you have to say to yourself is if all these positive things were supposed to happen, let's talk, if I may, about this trade for a minute.
Yeah.
Tell me exactly what exactly trade deals were signed, sealed, delivered, and implemented. The ones that are supposed to be with Japan haven't been done. The ones that are supposed to be done with South Korea. Look what's happened with our country. And listen, this is going to sound like I'm sucking up to part of your audience, but I love Canada. Everybody knows it was my home away from home for 25 years. I got friends in Canada that tell me, Pete, I love you, but I can't stand your country anymore. And the bottom line with that is we were the world's two biggest trading partners. We share so much commonality. Here, Trump went over and did it. Now, I'm not against Australia when I say this, but think about this for a minute, David, please. We went over and made this deal with Australia to get critical minerals. Do you know how much critical minerals are above our border and that it could help serve each other by us doing that same work? Canada has just a wealth of possibilities, and it's its own mistake forgetting about its own self as well. So there are a lot of things that we can go on, and I know your time doesn't have, that aren't spoken about it, and people have made assumptions that are not happening, and now we're getting to see the cracks in different places on different things. And I'm afraid as we get into next year, the weight of those cracks will get larger and it's going to pull most people down, not up.
Speaking of cracks, I want to get your reaction to this slide. You've lived through the 2001 dot-com bubble, or 2000 dot-com bubble burst, rather. And I want you to get your reaction to this chart. This is courtesy of Oxbow Advisors, guest I've had on the show. And they put together the slide that's been circulating around the internet, Peter, about circular financing in the AI tech space. So as an example, you've got NVIDIA, who is a chip maker, spending money to invest $100 billion in OpenAI, and OpenAI is deploying 6 gigawatts of GPUs from AMD. So buying AMD GPUs, which is a competitor to NVIDIA. And by the way, they're owned by the same family. So, or run by the same family, rather. So they're competitors, but then their money is going back and forth with each other. Oracle has spent $10 billion on NVIDIA chips, and OpenAI has a $300 billion cloud deal with Oracle. You see how it works here, right? They're just giving money to each other. At least that's what it seems on paper. People are calling this unsustainable. At a certain point, they're going to stop giving money to each other. Stats have shown that data centers accounted for up to 92% of economic growth in the U.S. this year. And without data center construction and hyperscalers, GDP would not have climbed to 3%. It would only be 0.5% annualized. So this that you're seeing on the screen right now has contributed to not just most of the market performance, but arguably most of the economic growth this year. Does this look like 2000, or is this just really different?
It's actually worse. And what I've used that chart in my own work, I play with it, a skit from the Three Stooges where $20 is owed to one and they pass it around. And by the time they pass it around, they've all paid off their debts with the same $20. This is a much better version than what occurred in the dot-com. This is vendor financing extraordinaire. And this is really, really concerning. Give you an example, as you and I speak here today, the Dow is
Yeah.
up 400 points. The S&P was actually down. The NASDAQ was down because these stocks are starting to take gas. And the concern that you have here all is now, not only if you want to buy into this story, we're now learning of data centers that were built but can't run because there's no ability to give them the power. And it's not going to happen anytime soon. And we can get all into the argument that they're going to need copper and all this other stuff. And, you know, part of the thing that's not discussed at all is our electrical grid system in the United States. I joke about it, but it's serious. Is so old that Thomas Edison installed part of it. We are going to have a huge, huge problem meeting the needs of the expectations that the market has built in these AI stocks. And the moment when people realize it's not happening or certainly close, that's when it will cave. I think we're much closer to that. But like I said, normally bubbles go farther and higher than most of us think they can. But clearly, when they do pop, most people who remain in it get hurt badly. And that's why I say I think the safety now is to the sidelines, not being involved in the market in an aggressive way.
So you don't want to participate in this circular finance here right now, even though some people say this bubble could get bigger before it pops.
Well, here's the problem with that, David, is it's kind of like that game you play where there was one less chair than the
Yeah.
people who played the music. You always thought you'd be the end. Well, the problem in this is you're right, it can go higher, but the percentage of people who will stay in from this point on and manage to get out at that high before it comes down and end up lower than where it is today is not worth taking that chance. But there's always people who think that they're going to be the exception to the rule.
But are you investing maybe in the periphery industries that are benefiting from this? Let's say copper, for example. People are talking about how copper is needed to build data centers and construction, and now natural gas is needed to power some of this. Nuclear power is very important. Microsoft just restarted a nuclear facility, by the way, a nuclear plant, because they know they need a base load that's stable and reliable. What do you think?
My argument to my clientele is if you're going to be in sectors, they need to be commodity related. Energy, food, etc. There's no question about that. I think there's far less risk in that. Again, depending on your time frame and also how much risk you're willing to take. Copper was my favorite metal. It remains it. I think it's slow but steady higher. The supply and demand scenario is getting much, much better. My single largest holding is in what hopefully will be Canada's next big copper gold mine. And so I really just think that commodities, if I'm going to have exposure, I like commodities. I'm also not against, and this also generates hate mail. I think China is continuing to move forward and past the United States. I don't want to be part of China. I don't want to live like Chinese live, but I'm not denying the fact that I think we're seeing this switch, and I'll see it in my lifetime if I live another 5 to 10 years of China becoming the number one economic power. And so they are growing. They need commodities. That part of the world is growing. I'll tell you another thing that isn't being spoken about. I think you'll be talking about it within 2 to 3 years tops, and that is the implosion of the European Union. I don't think countries there can continue staying, especially when the engine that used to drive it is basically blown up, and that's Germany. But that's a topic for another day.
Well, China's moving ahead faster than the U.S. How? In which way?
So many fronts, David. Militarily, technology-wise, uh, most people don't get to see parts of China to the point of, their transportation, how they move their people around. People are in many ways better off. Yes, is there some restrictions that are more harsh than others? Yeah. But I find that most of them, especially when you hear from the young out of China, is that they're okay with it. They feel that there's enough capitalist-like society part that they can take some of the other restrictions so they don't suffer some of the things here that we see and so forth. And people don't understand. I tell you, we have another crisis that no one wants to talk about in the United States, and that's an infrastructure crisis. Our infrastructure is so bad in the United States. Remember, in 2008, when Obama and Bernanke got together, that bailout was supposed to fix our infrastructure, which it never did. We're getting to the point now where with disasters around the corner. We have 100 bridges in New Jersey that are condemned. Engineers say no one should be going over them, but people still are because they have no other way that they can get people to working from. So another crisis that you'll be seeing more and more of in the United States is the infrastructure crisis that we have. That's complicated by the natural disasters that are increasing, which become worse because the infrastructure is poor and not strong.
Well, I'm just going to bring up one more thing that maybe you can comment on. I think maybe you'll have some thoughts here. Ray Dalio pulled some pages out of his book and posted this on LinkedIn in October 2024. So this was a year ago, but a lot of the things he said on this post actually came to pass, and I'll explain. When countries have big internal disorder, it is an opportune moment for opposing countries to aggressively exploit their vulnerabilities. The case at hand, risky U.S. elections coming in. This is before the elections, of course. Tensions between China and the U.S. are flaring up. He has a chart here, U.S.-China conflict gauge that he's put together. The prisoner's dilemma must be solved for peace to exist. And he's basically saying that there's going to be heightened conflict. In fact, where did I read this? He said, hang on, let me find the exact quote so I don't. Yeah, he's basically saying history has taught us that when there are relationship transitions and a weak leadership at the same time that there's big internal conflict, the risk of the enemy making an offensive move should be considered elevated. This is something that maybe the U.S., having had the strongest military forever, hasn't really considered, but he is talking about this potential risk. And furthermore, I'll just finish off here. My decision-making principles based on history have led me to treat the period ahead as a period of heightened risk, kind of like what you were saying. I believe it is the period of heightened risk because of some of the reasons I stated.
So China has, according to key generals of the United States this year, surpassed us militarily on many fronts. China, if you remember at the beginning of the administration, along with the BRICS, Trump quotedly said, I'm going to break their kneecaps. China managed to move around and get their exports going to other places in the country. Their economy's lifting, not declining. And what did the United States get out of all of that? Now he says, oh, well, we're taking in, we're doing great and all. The tariffs are taxes. He can call it whatever he wants, whatever and all. It was still paid by somebody on this side more on the ocean than the other side of the ocean. And I just think the fluff and the hope that Trump had brought in and all, he blew it by taking a big stick into this trade war versus an olive branch. And I think we'll see a lot of that come out as we get into next year. At least that's what forecasters are saying.
Just on that note, from Trump's perspective, one good thing that came out of the tariffs was higher tariff revenues, and now he wants to give back to the lower income class by giving a $2,000 dividend check to lower and middle income Americans. He's saying that he's claiming that it comes from, again, higher revenues from tariffs, so he's taking this directly out of the government's coffers. We will see if this actually passes. What do you think about this plan? This is just another stimulus check.
I think it's great talk, and it is a stimulus check if he does it, but I don't think it's going to make much of a difference from all the other issues that we have.
Peter, let's close off on this final question. Which assets are you most bearish and bullish on right now? Just taking everything we've talked about and all the assets we've discussed, which ones do you like best and worst?
The thing I need to tell you, which is going to cause a lot of mad emails again, is the biggest mistake anybody could have at this point in time is owning Bitcoin.
Okay, so you don't like Bitcoin, but what about the things that you do like? We've talked about copper, commodities, and gold. Is there any particular commodity that you think has really high growth potential right now, more than the others?
No, I think gold, silver, copper. Listen, the uranium stocks, they've gone up tremendously a lot. But that perfect storm continues. The need for electrical power is great, and it's going to continue and all. But I think where you invest in the world, if you said to me, Pete, I need some growth. Well, you know what? Look over in Asia. I love the Singapore market. I love the Chinese stock market. There are other areas, even like the Vietnamese market and all. But those are case by case. I don't like doing a cookie cutter for the whole world to be that regard. I'd avoid the western part of Europe. Like I said, I think the EU is in huge trouble. I think the United Kingdom and France, in particularly, are going to have huge economic and social and political problems and all. So I think where you invest in the world is as important as what you invest in.
Excellent. Thank you very much, Peter. Tell us where we can follow you.
Well, for those that own Bitcoin and don't like me, I'm going to leave you your email address. But petergrandich.com is the website, and mostly my comments are made on my X page.
There seems to be a lot of disappointment in the crypto space as we speak right now, so maybe you won't get so much hate mail, but we'll see. We'll see.
Let me just close on that. Is with all the talk of positivity in any market, yet the market itself is not going higher, 8 or 9 times out of 10, that's a signal that it's going to be going the opposite way.
You've been right before on many things, so let's make sure to follow Peter. Links down below, and please do check out our last interview with Peter. I'll put the link down there as well. Thank you so much, Peter. We'll speak again soon.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.